Hi everybody, this is Dimitri Pergamonic with MarketChameleon.com. Right now I'm going to show an example of how to use the Seasonality Screener by calendar month. In this example, we're going to look for stocks that have seasonal strength. In other words, stocks that tended to perform well during a particular calendar month. I'm going to go and jump into the example real quick, and we're going to filter out for the month of July. Over here, I'm also going to set the minimum number of years as observations. I set it to 8, but it'll go all the way up to 10 years. I'm also looking for candidates that had positive returns more often than not. So I'm going to set that win rate to 70% or above. I'm also looking for positive average returns over that period. So I'm going to set that floor to at least 2.5% or more. This is saying that over the course of 10 years or 8 years at least, the average return in the July calendar month has been on average 2.5% or more. I'm also going to set a floor to the median return right here below. And what this is just saying is that if the average return happens to be high, and if there was one outlier there that's pushing that average return, we also set a floor to the median return, which is that return right in the middle. So this is double check. Then I'm going to go ahead and sort this column over here. And what this is doing is sorting by the highest win rate. Over here, reading the results from left to right, the first symbol that popped up is QQQ. And we could see the calendar month here, July, 10 years. It's been positive all 10 years, 100% over here, no down years. The average return for QQQ has been 4.2% in July. The median return has been 4.3%. The best return 8.4%. The worst 0.6%. The standard deviation of these returns has been 3%, which is basically the variability of returns around this average. Then we have the Sharpe ratio over here, 1.43, which is taking this average return, dividing it by the standard deviation of those returns. So the higher this number, the better, right? Because we get a higher average return for the risk or the variability of those returns. One more thing I tend to do is set a limit to the market cap. So I go 50 billion or above. This will automatically screen out everything 50 billion or above. So now you could see that there are other stocks here, higher cap stocks that made the list. You could also do it by stocks in your watch list or stocks in particular ETFs like the S&P, Dow Jones, QQQ. The possible uses for this is I tend to like to prepare ahead of the next upcoming month, perhaps doing a bullish call spread or selling a credit put spread. Another use for it is you might want to screen out your watch list and see if there are stocks out there that potentially have weakness, and it's an opportunity to think ahead of how to protect those positions by possibly buy writing or doing some other option strategy that could offset some of that risk.